Hey, what's going on? My name is Ryan Stewman. I am the president and CEO of Closer Capital, where we help entrepreneurs like you secure access to the capital they need in order to scale your business. I'm glad you're here today. I'm going to talk about the number one issue preventing business owners and entrepreneurs from getting the capital they need. Let's talk about the big elephant in the room, credit. A lot of people don't really know a lot about credit. They know that there's a score, and they know that if you don't pay your bills, the lower the score, the worse the credit is. But that's most people's extent of the knowledge. And I'm not going to go into the fact that there's multiple credit repositories and bureaus and different complex algebraic ways to figure out what your scoring model for your score and everything is. And you might pull your score one place and it be a totally different score somewhere else because there's different models and everything else. But I want to give you some game about your credit score and the difference it makes in the amount of money, the terms of money, and how it affects you as a borrower. We don't need to know how credit scores work. It's not our job. It's not my job to go figure out the math. It's not your job. There's professionals that do that. And I've got some recommendations. You can find my guys down in the link. You can click on the credit repair link. I've negotiated a pre-negotiated discounted price for you because you're here on this channel. I don't get paid anything from it. It's just somebody I trust. Now, back to the point here. I want you to understand the significance between having great credit and shit credit, because a lot of people think they have good credit because they pay their bills, but you have to remember a lot of bills don't report to credit. Your phone bill doesn't report to credit unless you don't pay it. Then it'll go on there as a judgment. Your insurance payment doesn't report to your credit. Your rent payment doesn't report to your credit. A lot of the things that we use on a regular basis don't report to credit. The things that do report to credit are credit cards, bank loans, car notes, mortgages, and secured lines of credit by the big corporations, because it costs money for a corporation to report to credit. It does. It costs money not for them to file a judgment after the fact. That's cheap, but it costs money for them to tie into the software to being able to report. So it's typically only your big stuff. So maybe you've had a paid off car for 5 years because you're an entrepreneur and you're living lean and mean and everything else, but you haven't had a car note in a long time, so you don't have any credit and you struggle. So there are some simple ways to fix your credit. Number one is going to our guys down in the link. Just click that link. They'll send you over there. But let me show you the difference, what good credit, bad credit, and shit credit is. And then let me show you the difference it can make in the terms of your loan. And I think you're actually going to be blown away by this, okay? So number one, let's say you have perfect credit. So let's define what perfect credit is. It's 740 to 850 credit score. Let me say something that I think is very important to be said in this video. If you run across somebody that tells you they have a 900 credit score, tell them to fuck off, because it doesn't exist. I have pulled, if I just conservatively say that I've pulled 5,000 credit reports, and it's probably 10 times that. The highest I've ever seen is 838, okay? A lot of people say, oh, I got an 850, and you might on Credit Karma, but not on TransUnion. It's almost impossible. I've never seen it. Not saying it doesn't exist, but I've never seen an 850. I haven't even seen an 840s yet, okay? So 740 to 850. If you're in this credit, and you've got the financials too, because that's another part, but if you borrow $100,000, they'll loan it up to 5 years for someone with perfect credit and good financials. Okay. Now we've got longer terms. I'm just talking about an unsecured working capital line. Let's just keep it simple here. Let's don't complicate it with mortgages and shit. Unsecured, don't report to credit, line for you, working capital, 100 grand, 5 years at 12%. Okay. Right now, a lot of people have this idea that, oh, interest rates are 3%. The fuck they aren't. They haven't been since 2022 when there was a real estate boom. And by the way, that's real estate. Today I had a guy walk into my office, perfect credit, perfect everything, got a loan somewhere else. Last week I asked him what his interest rate is. He said 7.1 on a 30-year mortgage. Okay, so if it's 7.1 on the most secure asset in America, it's easily 12% with perfect credit on an unsecured, just boom. By the way, your credit cards, unsecured lines of credit, 38, 48%. Just putting that out there for you. Because I know people in the comments love to tell me about my job, right? So at this price, 12%, 100 grand, 5 years, you're paying $2,224.44 every month. Your total interest over the 5 years would be $33,000 you would pay. Most people, they would say these are good terms. If you look at everything, even if this is SBA, commercial bank, 12% is a low rate. That's 1% use of money per month. This is total interest, $33,000 over 5 years. If you're perfect credit, okay? If you have good credit, which is 680 to 740, okay? You take that same 100K out, now they're only gonna give it to you for 2 years, okay? They're gonna give you an unsecured line of credit at about 28%, depending on where you are in this spectrum, okay? If you're in the sixes, you're definitely getting 28%. Again, unsecured, uncollateralized, not backed by a house, not backed by a business, just a typical capital advance loan, right? SBA typically won't touch people unless they have perfect credit. So we're putting people in this category, $5,488.85 a month. Now, before you read the last line, you probably think, well, fuck that. That's a ridiculous interest rate. Those are ridiculous terms. Let's do some real math. It's cheaper. Now, we can always go back over here and maybe bump this down to, 10%, let's just say. We could get it down to maybe even, 10% and do this down for 2 years. And they're gonna pay less interest too, right? But here's the thing where we work differently at Closer Capital. With marginal credit, even with higher interest rates, you can still get the right term and get a better return on investment than the guy that had to pay for 5 years. Just putting that out there. Numbers don't lie. C paper credit, 600 to 680. C paper is like a C in school. It's not an A or B. You didn't necessarily fail. Your credit is okay, but it's not good. You got some blemishes on it, or it's new, okay? Same thing, you're gonna do 100 grand, but this time they're gonna give it to you at 12 months, 39%. You're a big ass risk. You don't have good credit. You need to borrow money. So the payment for a year is $10,196.72 a month. But check this out. This is actually the cheapest deal on the board. Because here's what a lot of people don't understand. The banking business is smart. The lending business is smart. The finance business has figured out all the ins and outs. But you're smart too, because you got me as your liaison. And you can make good decisions. And yes, the cost of capital monthly at $10,000 is significantly higher than $2,000, or significantly higher than $2,000. It's $8,000 increase. But the average person says, oh, that's all because of the interest. But it's not the interest. It's the terms, okay? And so this is where so many people get caught up in the lending world thinking, oh, a high interest rate, I can't do it. That high interest rate, I've shown you, I've increased it to 39%. What a ridiculous interest rate. This is the cheapest loan on the board because of the terms. Now, it's the most expensive return monthly, but the longer a bank gives you to pay off shit, the more they collect interest, because interest accrues monthly and gets reaccrued annually, compound interest. It's not a simple interest loan like most people think, especially if you're buying a car, if you're buying a house, or buying anything like that. But I just showed you how with marginal credit and bad credit, even though you get a good interest rate, the terms don't seem favorable because you're like, shit, that guy got a 5-year chance to pay off. I got to pay this off in a year. We actually got the cheapest deal cost of money. Highest interest rate, but the shortest term. See, when I was doing mortgages, which is where I started out at, people would come to me to refinance. Hey, I want to refinance on a 30-year note. It's like, hey, man, if you don't need to save the money, let's look at a 15 and 20-year note. Might be the same payment you're already used to making now. You just cut 10 years off your loan. You have to think not just in rates, but in terms. But you also have to think, hey, I got to have good credit, because, with the good credit, then I can also do this in 12 months with a significantly lower interest rate and make those adjustments. But having marginal credit and getting a higher interest rate with not your favorable terms, but not the lender's most favorable terms, but your favorable terms, is a way that you can still win. If you need to clean up your credit, the best thing you can do is get started on that right now. I pre-negotiated a price of $4.99 one time, get your credit repaired, go through the process. 6 months to a year from now, have new credit established, old credit that was on your report deleted, disregarded, and a fresh start to where you can get the most favorable terms possible. But in the meantime, if you have marginal credit and you need the money, we've still got ways to where the total cost of money is lower than what it would be even if you had perfect credit. We'll see you.